Most people don't lose money because they're stupid. They lose money because they're in a hurry. They see a headline, a chart that looks like a rocket ship, a friend bragging about a sure thing, and something ancient wakes up inside them, that fear of being left behind. So they speed up. They take shortcut. They turn investing into a high-stakes sprint, and that's usually the exact moment the market collects its fee. Not a fee you can see on a statement, a fee paid in something more expensive: years, sometimes decades. Because here's the uncomfortable truth Benjamin Graham would insist on even today. The market doesn't punish you for being wrong. It punishes you for being fragile. And fragility comes from the same place every time, trying to get rich quickly. So if you click this video because you want the safe path, I'm going to give you something rare, a way to build wealth that doesn't depend on perfect timing, hot tips, or being the smartest person in the room. By the end, you'll have a one-page defensive investor blueprint you can actually follow. Even in a loud market full of hype, AI mania, meme stocks, crypto noise, and options temptation. But first, you need to understand one idea that changes everything. Not return, not beating the market. The idea is ruin. Because if you avoid ruin, you don't just survive, you compound. And compounding is what sets you free. Let me show you why getting rich slowly isn't a slogan. It's the only safe path. Picture two investors. The first one is chasing fast money. Maybe it's weekly options. Maybe it's zero DTE, meaning 0 days to expiration. Maybe it's a story stock with a future so exciting that nobody cares about the present. Maybe it's a crypto project that promises a whole new financial system right after it finishes melting down for the third time. This investor isn't trying to be reckless. They're trying to be efficient. They're trying to speed run wealth. The second investor looks boring, almost suspiciously boring. They buy diversified low-cost ETFs or index fund, or they pick a handful of stocks only when the numbers scream margin of safety. They keep cash and bonds like shock absorbers. They rebalance. They invest automatically through a 401k or a Roth IRA. They don't talk about it. And here's the twist. The second investor is the one taking the market seriously. The first investor is taking the market personally, because the market is not a casino, but it loves casino behavior. It will happily let you win early. It will even reward you for doing the wrong thing, just long enough to build confidence. And that's the most dangerous gift it can give you. Graham's genius wasn't predicting the future, it was building a philosophy that protects you from the future, whatever it is. He understood that the biggest enemy of wealth isn't volatility, it's permanent loss of capital. Volatility is a feeling, permanent loss is a fact. And the difference between those two is the difference between investing and speculation. Graham used that distinction like a knife. Investment, he said, is an operation which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Notice what comes first, not adequate return, safety of principal, because without safety, return is a mirage. That's the foundation of getting rich slowly. It's not slow because it's weak. It's slow because it refuses to gamble with your future. Now let's make this real. You can recover from a bad year. You can recover from a bad decade if your savings rate is strong and your behavior is disciplined. But there are certain kinds of losses you don't recover from, not because it's mathematically impossible, but because it breaks you. It forces you to sell at the worst time. It makes you stop investing. It makes you swear off the market forever. That's ruin. Ruin is when the game ends, before compounding has time to do its job. And compounding only works for people who stay in the game. That's why the true opposite of getting rich slowly isn't getting rich quickly. It's getting wiped out. So the question changes, not how do I maximize returns this year, but how do I become the kind of investor who can't be knocked out? This is where Graham gives us one of the most powerful characters in finance, Mr. Market. Imagine the stock market as a manic business partner. Every day, Mr. Market shows up at your door and offers to buy your share of a business or sell you his share. And his price isn't based on careful valuation, it's based on his mood. Some days, he's euphoric. Everything is the future. Every company is disrupting. Every chart is destiny. Other days, he's depressed. Everything is doomed. Every risk is fatal. Every dip feels like the end. The normal investor thinks they have to listen to Mr. Market. Graham's investor uses Mr. Market because Mr. Market is not there to instruct you. He's there to serve you. That's the whole point. If the market is euphoric, you don't have to join the party. You can simply decline the offer. If the market is depressed, you don't have to panic with it. You can look for bargains, but you can only do that if you have emotional discipline and structural discipline. Emotional discipline means you don't confuse excitement with opportunity. Structural discipline means your portfolio isn't built in a way that forces you to act emotionally. And that's where most people fail. They build fragile portfolios. They put themselves in positions where they must be right now. They concentrate too much. They use leverage. They borrow on margin. They chase momentum without a valuation anchor. They ignore fees and taxes and turnover like those things don't count. They treat time in the market like a meme. And then they build a portfolio that can't survive a storm. And then, inevitably, the storm arrives, because storms always arrive. If you've been investing long enough, you've seen several versions of the same movie. 1929, 1973 through 1974. The dot-com crash, the 2008 financial crisis, the COVID shock, the inflation and rate shock after. Different costumes, same plot. People don't panic because prices fall. They panic because their plan falls apart. So let's talk about why getting rich slowly is safe. Not because it's conservative, but because it's engineered. Here's a simple truth that feels almost unfair. Big losses are not symmetrical. If you lose 10%, you need about 11% to get back. If you lose 20%, you need 25%. If you lose 50%, you need 100%. And that's before you even factor in the psychological damage of watching half your money vanish. This is why Graham's margin of safety is the single most important metaphor in investing. Think of margin of safety like a parachute. You don't buy a parachute that usually works. You buy one designed for worst-case scenarios. You don't say, "I'm probably fine." You say, "What if I'm wrong?" Margin of safety is what allows you to be wrong and survive. It's not pessimism, it's realism. Because in investing, the future is not a test of intelligence. It's a test of resilience. Now, if you're a regular person watching this, building wealth for retirement, trying to protect your family, trying not to blow up your finances, this should feel like relief. You don't need a miracle. You need a system. So let's build it slowly, safely, on purpose. I'm going to give you a defensive investor retirement blueprint inspired by Graham. It's designed for real life in the United States, where people have 401k plans, Roth IRAs, taxable accounts, student loans, mortgages, kids, and a market that never shuts up. And I'm going to structure it the same way a good engineer structures a bridge. Look impressive, but to hold weight when things get ugly. Step one is not a stock. Step one is your floor, because the market can only hurt you in one way, by forcing you to sell at a bad time. So we remove the forced selling risk first. That means an emergency fund. And I know some people hate hearing this. They call it cash drag. But the function of emergency cash is not return. It's stability. It's what keeps you from liquidating your investments when your car breaks, your job changes, or life does what life does. In Graham's world, that's not optional. That's part of safety of principle. So your first bucket is cash for life. Not cash to time the market, cash to avoid disaster. Step two is to eliminate high-interest consumer debt. If you're paying 18% on a credit card, you are not investing by buying stocks. You're leaking wealth through a hole in your pocket. Fixing that hole is a guaranteed return. That's not motivational advice. That's math. Now you have a floor. You're less fragile. And now your investments can actually behave like investments. Step three is your core engine. Diversified, low-cost ownership. Most people don't want to hear this either. They want the secret, but the secret is that there isn't one. And that's the point. For the defensive investor, Graham favored broad diversification and caution. In today's world, for many people, that translates naturally into low-cost index funds and ETFs, vehicles that give you diversified ownership without the burden of picking winners. And yes, you can still be a Graham investor using index funds, because the philosophy isn't pick obscure stocks. The philosophy is don't speculate, insist on value, control risk, and avoid overpaying. For a typical U.S. investor, that often means a simple mix: a total market index, maybe a global component, and bonds for ballast, adjusted for age, goals, and risk tolerance. But the key is not the exact fund. The key is the behavior it enables: consistent contributions and disciplined rebalancing, because the slow path wins through repetition. This is where retirement accounts become powerful. Your 401k is not just a tax tool, it's a behavioral tool. Automatic contributions mean you invest through headlines, recessions, election cycles, rate hikes, and market euphoria. A Roth IRA isn't just tax-free growth. It's a way to buy time. Taxable accounts aren't just extra investing, they're flexibility, if you keep them simple and tax efficient. This is the core of getting rich slowly. Build a machine that keeps investing when you're emotional, because the market's job is to test your emotions. Now, the next step is where Graham's name really earns its place: margin of safety. Even if you're an index investor, you can apply margin of safety through your overall plan. You avoid leverage. You keep fees low. You keep an allocation that you can hold through a crash. You rebalance rather than chase. And if you do choose individual stocks, because some of you watching this are analysts, value investors, and serious students, then you apply margin of safety directly through valuation and quality screens. This is where people get tripped up, because they think value investing just means cheap. Graham didn't mean cheap like a discount store. He meant cheap relative to intrinsic value, with financial strength that can survive bad conditions. So let's give you a practical version of the Graham checklist. not as a complicated spreadsheet, but as a filter that protects you from story stocks. Here's the first question. Is this a business or a narrative? A narrative sounds like total addressable market and platform and disruption. A business shows you earnings power, balance sheet strength, and cash flow. So Graham would look at financial strength first. He cared about the balance sheet the way a pilot cares about fuel, because you can't fly on hope. So you ask, does the company have a strong current ratio? Enough liquidity to handle stress? Is debt reasonable, especially in a world where interest rates can change the rules quickly? Has the company demonstrated stable earnings over time, not just one great year? Does it have a history of dividends or shareholder-friendly behavior, not dilution as a lifestyle? Is it buying back stock responsibly or issuing shares to fund the story? Is profitability real or adjusted into existence? Is cash flow consistent or is it constantly just around the corner? You don't need to be a CPA to use this. You're not trying to predict the future perfectly. You're trying to avoid obvious fragility, because fragile companies become fatal investments in bear market. Now, the next question is the one most people skip. Even if it's a good company, am I paying a safe price? This is where price versus value becomes everything. Price is what the market shouts at you. It's a number on a screen. Value is what you would pay if you were buying the whole business with your own money and you had to live with the consequences. Graham's approach to intrinsic value is not mystical. It's grounded. It's earnings power and asset value weighed with skepticism and then discounted to reflect uncertainty. And this is the part that separates investing from gambling, you demand a margin of safety. You want room for error, because error is guaranteed. Let's bring this back to modern temptations, because the market always invents new ways to make old mistakes feel fresh. Today, the temptation might be AI stocks, or some next-gen theme, or a company with no profits but a convincing CEO, or a trend so popular you feel stupid not owning it. Graham would ask, is this investing or is this speculation wearing a suit? Because speculation isn't evil, it's just mislabeled. If you want to speculate with money you can afford to lose, that's a personal choice. But if you call it investing, you're lying to yourself, and that lie is what makes it dangerous. The defensive investor does not confuse entertainment with a plan. Now let's address the real reason people hate the slow path. Because it feels like you're missing out. It feels like everyone else is sprinting while you're walking. And for a while, that can even be true. In a bull market, discipline looks like stupidity. In a mania, skepticism looks like ignorance. In an options frenzy, boring looks like fear. But then the cycle turns, and suddenly, boring looks like wisdom. The slow path isn't designed to look smart in a mania. It's designed to keep you alive after the mania. That's why it's the only safe path. Now, we need to talk about the boring edge, the part most people skip because it doesn't make for exciting screenshot. Bonds, cash, allocation, rebalancing. Graham treated bonds seriously because they do a job stocks can't always do. They stabilize. They reduce the chance that a stock market decline becomes a life crisis. For many investors, especially those closer to retirement, bonds are not a drag. They're a buffer. And that matters because retirement isn't just about building wealth. It's about not being forced to sell. The sequence of returns risk is real. If you get a bad market early in retirement, withdrawals can do permanent damage. So the defensive approach says, Plan for storms, not sunny days. Your allocation is not a statement of optimism. It's a statement of survival. And rebalancing is your way of refusing to chase. When stocks soar, rebalancing forces you to trim and take profits. When stocks crash, rebalancing forces you to buy when it feels terrible. It's the opposite of what your emotions want. And that's exactly why it works. This is how you turn Mr. Market into a servant. He offers you insane prices. You rebalance. He offers you bargain prices. You rebalance. You don't need to guess. You need a rule. Now let's put the full blueprint together in a way you can remember. Here it is, the one-page defensive investor retirement blueprint. 1. Build your floor. Emergency fund first, then kill high-interest debt. Reduce fragility. 2. Automate ownership. Use your 401k, Roth IRA, and low-cost index funds or diversified ETFs as your core. Make it boring on purpose. 3. Add ballast. Hold bonds and cash appropriate to your time horizon and your stomach, not because you're bearish, because you're human. 4. Demand margin of safety. If you pick individual stocks, use a Graham-style checklist: financial strength, earning stability, shareholder-friendly behavior, and a price that gives you room for error. 5. Rebalance. Don't react. Schedule it. Quarterly, semi-annually, or annually. Keep it simple. Let rules beat moods. 6. Treat speculation honestly. If you must play with meme stocks, crypto, or options, keep it contained. A small, clearly defined portion you can lose without altering your future. Never confuse it with your retirement plan. 7. Protect your temperament. Limit your financial news diet. The market is loud. Your plan should be quiet. Mr. Market is not your coach. He's your counterparty. That's it. That's the slow path. And the reason it works is almost too simple. It avoids the mistakes that end the game. Now, let's go back to where we started. The investor in a hurry, the one chasing the rocket ship. That person isn't evil. They're not dumb. They're reacting to a world that feels unstable. High prices, high noise, high pressure, and that constant sense that if you don't move fast, you'll be left behind. But moving fast is not the same as moving safely. Graham would tell you something that sounds almost like an insult until you feel the freedom in it. You are not required to participate. You're allowed to be patient. You're allowed to say, not at this price. You are allowed to hold cash when value is scarce. You're allowed to own bonds when fear is high. You're allowed to build wealth slowly because you are building it to last. That's what most people miss about getting rich slowly. It's not slow because the returns are tiny. It's slow because the process is sane. It's slow because it refuses to convert your future into a bet. It's slow because it doesn't need to be right this month. And that is exactly why it's safe. Because the market can outsmart you. It can out-hype you. It can out-noise you. But it cannot defeat a disciplined plan that refuses to die. So the next time you feel that familiar itch, the urge to chase, the urge to just do something, the urge to buy because everyone else is buying, remember Mr. Market at your door. Remember that he's moody. Remember that his prices are opinions, not facts. And remember what Benjamin Graham was really teaching. You're not here to be entertained. You're here to build a future that can't be taken from you by a chart. That's why the only safe path is getting rich slowly. Not because it's conservative, because it's durable. And durability is what turns time into money. If you want, in the next video on Benjamin Graham investing, I'll turn this blueprint into a printable checklist. The exact screens a defensive investor can use to filter stocks and build a crash-resistant portfolio without relying on luck, hype, or prediction. Until then, keep one thought in your pocket. The goal isn't to win today. The goal is to still be here tomorrow with your capital intact, your emotions under control, and your compounding machine still running.